which is working with unearned revenue, accrued revenue, and installment notes receivable. So working together 9-1, we're going to look at unearned revenue and accrued revenue. Unearned means that we received the cash for it, basically, but it hasn't been earned yet. An example that we're going to do in the working together is rent. So somebody has paid us rent for a facility, a building, whatever the case may be, and they paid us 3 months worth of rent. Well, the rent for the future months is unearned because we haven't gotten to that point yet. They've just paid it in advance. Where accrued means that we've earned it, but we haven't received it. And that'll be like interest. So if we don't receive the interest until the note that somebody, has with us is paid, then we're earning the interest each month. We're just not getting it until the end. Okay? So there's your unearned revenue versus your accrued revenue. Okay? So for working together 9-1, Winston Incorporated is preparing its December 31st financial statements for the current year. On December 1, the company received a $4,200 rent payment from Youngston Company. The payment is the $1,400 per month rent for December of the current year through February of the next year. Winston records rents receipts initially as revenue. General journal pages are provided, and we'll walk through the following examples. Okay? So we need to journalize the adjusting entry for an unearned rent on page 13 of the journal. And this is, again, at the end when we're preparing our financial statements. So this is an adjusting entry. Okay, and we've received the whole $4,200, but the rent is actually only $1,400 a month. So the rent for December is good, but the rent for January and February are unearned because we're not there yet. Okay? So again, December 31st. We're actually reducing our rent income. Okay? And we're increasing unearned rent. So initially, when we received the whole $4,200, we put it into rental income. Now with this adjusting entry, we're decreasing that rental income by January and February's rent so that this year is correct in that account. Okay? So we're decreasing it, and this is other revenue. This is the category it fits in, just to have as a reference. And we're increasing this as a liability. All right, and $1,400 a month is the rent. So January and February, that's $2,800. Okay, that's where this $2,800 is coming from. Okay. And so basically, at the end of the period, the fiscal period, what is unearned? Okay? And it's basically, the answer is January and February's rent. Okay? That's the first part of that one. Then it says to also do an adjusting entry for the accrued interest income. And so it gives us, we've got two notes. Let me bring this over here so you can see it. You can see it in your book. We've got two notes. The interest rate, the number of days for the term, the principal, and the date that they were issued. Okay? So what we have to figure out is between November 22nd and December 31st, how much interest did we earn or accrue? And then from December 8th to December 31st, how much interest did we accrue? So that we can record that in this year's financials. Okay? And it gives us a little working space down at the bottom to do this. Okay. So for note 22, the principal is $6,000. Oh, I can't see that. Let me move this. Okay. Principal was $6,000. The interest rate is 8%. The fraction of the year. So we've got to figure out November 22nd to November 30th is how many days? 8. And then December 1st through December 31st is 31 days. So that's 39 days. Here's our fraction of the year. Okay, we've earned 39 days worth of interest. And then for the second note, it's $5,000, 9% interest, and from December 8th through December 31st, it's 23 days. Okay, now we've got all the numbers. Now we can do the math. So 6,000 times 8%, make sure you're using the percent correctly, times 39 divided by 365 should get 5129, and 5,000 times 9% times 23 divided by 365, 28, 36. So together, all of our notes that we need to do adjustments for will total $79.65. So we don't have to do an adjustment for every single note that we have. We can do one adjusting entry at the end for all of the notes that are overlapping from one fiscal period to the next. Okay? So there's our dollar amount right there that we need. Okay, so again, December 31st, interest receivable, okay, because we're set to receive this when we actually get the note paid back later on, the end of the term. So this is increasing, and this is an asset. Okay, and interest income. Okay, and this will actually close because it's part of income. Receivable is an asset, won't, but revenue closes. Okay, and so this will close, and we just need to think about that and understand that when we're making our reversing entries. Okay, so this is to oh, I gotta get the numbers in. $79.65. Okay, so this is to take care of those accounts that are kind of overlapping with the unearned, the accrued revenue, and then we close everything out, we do our financial statements, and then we've got to get them back to where they were so that we can actually start the next year and be correct. Okay, actually let me write a little note here. This right here is outstanding note. This is from an outstanding note receivable. Okay. So these adjusting entries will be reversed on January 1. Okay, so heading, reversing entries. January 1. All right, so we need to reverse this so that our rental income will go back up for the full amount that we're going to earn in January and February. Okay? And then unearned rent, once we get through January and February, and we're doing this again at the end of that year, it's not unearned anymore. So we need to make sure that that goes back to 0. Okay? And remember, the reversing entries, you're just exactly reversing what the adjusting entry did. So unearned rent is your debit. And rent income is your credit. Okay? So now we know that there's January 1st, there's $2,800 that's coming in for the January and February rental income. So $1,400 a month. Okay? All right, so also on the first, we're going to reverse the interest income. And interest receivable. Okay, so that was an asset before. We're just going to reverse that. That'll go back to 0. Interest income, though, was actually closed. So when we reverse this, that $79.65 actually creates a debit balance. Okay, so again, if we look at the T's for this on interest income, okay, when we created it, we created a credit and then we closed, so therefore this account is now 0 after we're closing. Okay, now that we reverse it, we're creating a debit balance of $79.65. Okay, which is kind of like a negative balance. But then what happens, if you remember from when we did this with expenses, when we actually record the full amount, let's say in March, we get the full payment for the note plus all the interest. When we get that full amount that gets paid to us is interest income. And let's just say for our purposes that was $930. Okay, so this was the reverse, and this is when it got paid to us. Okay, the difference between those two is $850.35. Okay, that's your balance. That's a credit balance. Okay, and this is the actual amount of interest income we'll receive for this period. So it's actually correct, because this was last period, this is this period. Okay, we received it all in this period, but we recorded what was appropriate for the partial part of that year in the previous fiscal statements, financial statements. Okay, so hopefully you're getting to where you can wrap your head around reversing entries and how some of this works. It takes a little time. I understand it a lot better now than I did when I looked at it first. Okay, and maybe you don't get it now, but you're going on to do some college accounting, then hopefully it'll click for you when you get through it that way. All right. And again, the whole point of this is matching revenue with expenses. Okay, that accounting concept that's so important to the accounting profession. All right, there's working together 9-1.